All right, let's get to the markets. I mentioned how they're down today as the debate for more Fed stimulus continues. Our guest says that the Fed cannot wait much longer to do it. Keith Springer, president of Springer Financial Advisors, and has a book out called Facing Goliath, How to Triumph in the Dangerous Market Ahead. So good to see you, Keith, and thank you for coming on. This idea about the Federal Reserve, giving the economy some more juice. You think they will need to act? Huh? I guess today's market sell-off, by the way, is mostly China-related. They had 8% growth, but that's not what people expected. People expect a little bit more than that still.
Well, the market is pretty much addicted to the stimulus, and you can pretty much see it. Every time we get better than economic numbers, the market goes down. But when we get disappointing numbers, the market goes up. Yesterday, the jobless numbers were disappointing. Market had a strong rally. The Fed is really looking for low inflation. I think they've laid the blueprint. They're looking for negative 2%, around 2% inflation. They want to see unemployment not really pick up, or, employment numbers continue to be weak. And, I think it's a given we're going to get QE3. We have an election year you were just talking about.
Yeah.
They're probably trying to time it a little bit for that, so it peaks around the election. I think it's a given. I don't think they have much choice.
Yeah, QE3 would be more quantitative easing, more bond buying, more kind of stimulus added to the economy. And the reason there's a 3 on it is because we've done it 2 other times. So if the assumption is being made by people like you that we're going to do it a third and then we or they and the Federal Reserve don't, then what?
Well, you want to be out of stocks at that point. I think the stock market is pretty much addicted to the stimulus. It's really being driven by stimulus. We've got to remember the QE programs take 6 to 9 months to feel the effect, and then you feel them for 6 to 9 months. But each time, it diminishes a little bit.
Right.
So they did the last one in November. We felt it around September. It's going to start to wear off this summer. You heard Bernanke about a month or 2 ago say, look, we've got to be prepared for it because he knows it's wearing off. But he wants to see inflation pull back. He wants to see a little bit weaker job picture, so he has the ammunition to do it. But I think it's a given. I think they're going to do it. I think they might be timing it for the election. The stock market wants it. Investors have to be careful, look for income dividends and things like that, not take too much risk. But, we've got to remember, too, Connell, this is the 4th year of a presidential cycle. The market is most likely going to peak sometime this year.
How much?
And then, investors really...
I was just going to say, how much would outside factors play a role in that? Because as we were just talking about with Monica, and as you mentioned, it's an election year. So, yeah, we know our economy is being maybe over-scrutinized and looked at very carefully and how it affects the election. But then today the market's down because the Chinese aren't growing as much as we thought they were. Or, next week it might be another blow-up in Europe or something like that. Will the Federal Reserve base those decisions more on what happens outside the U.S. or things that are happening here inside domestically?
Well, he's got domestic pressure. Remember, he's got political pressure and public sentiment pressure. It has to be domestic. It has to be domestic-driven. But he doesn't want to see Europe fall down either. I remember, we're a big part of the IMF. Every time the IMF gives Europe money, it's part of our money.
Right.
It's going to be somewhat affected. Europe is slowing down because, they're in a recession. China's slowing down because their exports to Europe. But mostly, it's going to be here in this country. The Fed is going to be looking at slower growth, lower inflation, because they know every time they do a QE, it raises inflation. Every time we did QE1 and QE2, inflation went through the roof, and they know it's going to happen again, so they've got to be careful. And that's why investors just have to be a little bit careful here, but prepare for a peak probably sometime this year.
All right. Keith Springer's book is called Facing Goliath, How to Triumph in the Dangerous Market Ahead. Thank you for coming on. Appreciate it.
Thanks, Colin. Great to be here.